Today, we're diving into some recent headlines for real estate investors that we want you all to be aware of. A couple of different articles here. One is new asset protection laws that are happening here in the state of Florida. We had the community reach out, wanted to understand a little bit more about that. We're also going to talk about the Fed and kind of like state of the Fed right now, and they're in a little bit of a kind of like a pickle on what to do next, and things have changed and they're in a state of flux. So we're going to give you an update there, and then we're going to talk about new momentum around rent-to-own programs that are being really championed by Fannie and Freddie to see what that effect is for renters, for rental property investors, for the economy at all. Just a potpourri of different news headlines today that I know our community cares about. Welcome, everybody, for your weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with you today.
Gregg, how is it being in the studio without me, but with me here on the other side of it? I feel like we've only done solo shows, but not with each other remote. How are you feeling over there, bud?
I mean, it's a little lonely. You're like so close, but so far away. But you know, I'm a persevere. We're gonna get through it.
I believe in you, man. I believe in you. But we're going to dive right into the topics du jour, Gregg. Do you know what that means? Topic du jour?
The topic of the day.
It's the topic of the day. First one that we are starting off with is Florida passes these new protected Series LLC legislations. This is something that got sent in by our community. You were asking for it. And basically, Florida legislature has passed CS/SB 316 and CS/HB 403 to add protected Series LLC provisions to the Florida Revised Limited Liability Company Act, aligning with the Uniform Protected Series Act. This makes Florida one of the states with a comprehensive and uniform legal framework for Series Limited Liability Companies, LLCs, enhancing its appeal for business formation. The legislation introduces horizontal liability shields that insulate each series from the debts and obligations of the Series LLC and all other protected series. To maintain these liability shields, Series LLCs must follow strict record-keeping rules for asset and liability segregation or risk having the shields pierced by creditors. Takes effect July 1st, 2026, coming right down the pike, allowing for the state to get ready and for filings to take place and to get everybody going. GC, when I read this really sounds like it's written for businesses and kind of like people having different businesses. And as we know, each rental property is kind of like its own little business of its own, right? So can you first of all, when I read all those technical terms, can you make it make sense to rental property investors how this relates to them?
Yeah, absolutely. I think if there's, I put this into ChatGPT, who stands to benefit from this protected series LLC the most? And number one, it said rental property investors, and number two, business owners in the state of Florida. And the reason is because, your rental property is a business, just like you mentioned. Ultimately, what's happening here is there is an opportunity to streamline and make asset protection less costly for those who use LLCs to protect each one of their assets in an individual LLC. So an opportunity here, and I know we'll get a little bit more in depth into it, but an opportunity here to streamline that process, make it less costly to have that level of asset protection.
Yeah. So opportunity to streamline for people that want asset protection is kind of like the big headline, right? It's giving you more options, more tools in order to do this. Am I understanding this correctly, GC? When I think of asset protection from a rental property investors, I think of folks that want to put their rental properties into LLCs so that if something happens inside of a rental property, you can't come after my own personal assets and things of the sort. Is that essentially kind of like at the core of this thing with an LLC?
Yeah, pause, but you know what? I probably don't want to go too much down that path just
Yeah.
because I need everybody to know that I am not a lawyer. I am not an expert in asset protection, and I am not your guy to advise you on, why you would do an LLC over a non-LLC. So just
Yeah.
let me put that out there for everybody. I'm just trying to do my best as a real estate investor here who has like 1,000 LLCs to highlight what, what the options here are. But yes, the school of thought is that to get the highest levels of asset protection, people use an LLC to limit the liability that they could have if there was an unfortunate happening inside one of the rental properties.
Yeah. And it sounds like with this new law, essentially before, um, can you explain to me what the change is here? Like right
Yeah,
before the show, you were basically talking about how like you used to be able to have like one LLC, but then if something happens in one property, they can get it from another. So people would set up different LLCs, and it'd
yeah.
be like an individual LLC per property. But now with this like one LLC, it allows you for these other protections. Can you give me kind of like the rundown of what changed here?
Yeah, I'll go through what changed. I was actually able to speak with Julia McKillop, who is of the McKillop Law Firm. She is the estate and asset protection attorney I use for my own personal estate, and we use her for asset protection for JWB, and a lot of our clients do. So she was so nice to jump on the phone with me and kind of walk me through it. So I'll share some of that information, but just know that when it comes to asset protection, just because we're going to talk a lot about LLCs here, that doesn't necessarily mean it's the right way for you, or it doesn't mean it's the wrong way for you. Go and talk with somebody that you trust when we're talking about asset protection, who is an expert in that field. But let me just kind of walk you through what has really changed. Previous to July 1st, if you were a rental property investor and you wanted to maximize your asset protection, you might put all of your properties in an individual LLC. Let's say you had 10 properties and you wanted to go down this level of asset protection, you may incur the cost and the brain damage to have an LLC for one property, property one, property two, property three. Each of them would have a different LLC. That would be 10 LLCs for 10 properties. Now it becomes cumbersome to be able to maintain that. And at the end of the day, the whole goal for having an LLC is to protect you or to protect your assets and to limit your liability. And that can become cumbersome when you have that many LLCs. So what's changing now is this protected series LLC law allows individuals, let's just say rental property investors here, to have one parent LLC. And then below that, you're able to have a series. And a property can be in a series, which
Mm,
is not an LLC, but it has the same level of protection. It's called a horizontal shield of protection. So you get, in theory, the same protection that you would have had if you had had 10 individual LLCs for 10 properties. But by doing this, you have the opportunity to have one LLC, which is the parent, and then 10 series beneath it. Now,
mm.
that's the layman's term to it. There's a whole lot more to it than that. Don't run off and just go and do this because you heard this from me. I want to tiptoe on this, but that's the thought process here, and that's where you get some cost savings potentially, and a couple of other things just to be able to streamline the process and make this a little bit more manageable for maximum asset protection.
That makes a lot of sense. It's funny when you talk to investors like you that have a whole bunch of different rental properties and a bunch of different LLCs. It's almost like you have to have like a full-time job naming new LLCs all the time because you got to come up with all these different names and you got to remember all this stuff. So having one in a series kind of like sounds like a simplified way of thinking about it, and a simplified way of structuring it. Now, you also mentioned that there's a lot we don't know about this because this is a new law. There's no precedence here. Can you kind of like tell me what McKillop told you about that?
Yeah, yeah. Julia made it a point to let me know that, there is no case law because this is a brand new law. And case law is important when it comes to interpreting the law. And I said, how long is it going to take for there to be case law to figure out how this is interpreted in the state of Florida? And she said it might take 2 to 5 years before the courts have some challenges that they have to work through, and then they make rulings, and then there's case law. So, with anything new, it doesn't mean it's a reason to not do it, but it's just something to understand that even though the law says that you have this shield, this horizontal shield,
Hmm.
the same levels of asset protection without having 10 individual LLCs, it hasn't been tested yet. And there's going to be a creditor that is going to go after somebody
Yeah.
to try to pierce that. And then we just have to, she made it very clear to say, we have to see how this is going to play out. So
Yeah.
the other thing she made it really clear to me is that this does not decrease the level of um, the importance of making sure that you have meticulous record keeping and you do not commingle funds in between your different series. You have to treat each series almost like it's an LLC, even though it's not, because
Hmm.
if you do that, then you could open yourself up for some liability there. So it's, I think it's something that can um, streamline the entire process. It's a little bit easier to kind of understand how your asset protection tree may work for your properties. I think it's something that can reduce costs
Hmm.
potentially, but it doesn't reduce the amount of work that is necessary to maintain the integrity of each one of these entities. Call it a
Yeah.
series.
Yeah.
That is really, really important. So that's still going to be there
And that's
for.
what they mean by the record keeping, right? Like the record keeping is kind of like the name of the game here of being able to like prove all this type of stuff. There's just kind of like another layer of making it a little bit more simple at another, structurally.
Yeah, and I think commingling funds is a big no-no as well.
Okay.
That's where I think a lot of entities run into problems. They start treating each of their bank accounts like the same bank account, and then they could open themselves up for liability there.
Got it. Chris Gonzaga from the illustrious Hudson Valley asked, so you have to be registered in Florida as an LLC to do this?
Um, for a lot of these questions, I'm probably going to not know the answer. That's probably one that I don't know the answer to. Unfortunately, Chris, I would say reach out to Julia is a great resource. Julia McKillop Law Firm. She was one of our sponsors at the summit. She spoke, so many of you got to meet Julia. She's a wonderful person. So I would encourage you to look up the McKillop Law Firm and reach out to Julia and her team to give some of those answers.
Yeah. And then a couple comments here in the chat. Leo Whitman says much more complicated to get loans because each series doesn't have its own EIN number. And Greg is correct. Case law is not well proven with Series LLC structure. And then Michael Santora says if you can't commingle funds, you'll need multiple checking accounts per property.
Yeah, I think all those are really astute comments. I like Leah's comment bringing up the challenges of financing. Again, this is an unproven thing, and any little small thing when it comes to something new, when it comes to the financing part of it, opens itself to potentially being a something that doesn't exactly work the right way. We just don't know yet. So just it is something I think if you're curious about it, reach out to your professional, your asset protection professional. It might be something that's a good thing for you, but just know that it's not proven yet, and there will likely be some variables that you'll have to negotiate and navigate. Think of in financing, think of insurance, think of some of those things. We don't exactly know how that's going to work.
Yeah, and GC, I think when you start talking about the commingling piece of it, I think there's a couple of questions that come from like Tarsha and John are asking the same question. Are this not being able to commingle funds mean that each property needs to have its own bank account?
That's my understanding. Yes.
Okay, there you go. Okay, so a couple
Yeah,
different bank
commingling
accounts.
of funds means that instead, generally what it really means is you you need to have separate bank accounts for your separate entities for them to have the integrity of being an entity. And if you just use one bank account and you just send money back and forth, the courts look at it and they're like, well, this wasn't really a separate entity, so they don't afford you the protection
Yeah.
from the liability. So yeah, commingling of funds would be just kind of using bank accounts interchangeably, and that's not a good thing when it comes to asset protection.
Got it. GC, when you first got started, right? Like you and your partners bought a property, bought another property, and then you got to like 40 rental properties relatively quickly. Um, what was your at the time kind of like what was your strategy for asset protection at the time?
Well, I didn't have a lot of assets to protect in the beginning, so there wasn't a whole lot of thought about asset protection when I was starting when I was 23, to be quite honest. But we did start to think about it pretty early on, in the sense that we were starting to accumulate a lot of rental properties in a short period of time. We bought about 40 rental properties in about a year and a half, and so the thought and topic came up, hey, what should we do? Now, there are many schools of thoughts on what's important for everybody. For us, when we started, we focused on keeping the properties in our personal name until we reached a certain level, and we loaded up on insurance. And that can be a strategy that can work for some folks. For some folks, that's not the right strategy. But in the beginning, that what allowed us to maintain the level of asset protection that we needed, which was right for us. And it allowed us to be nimble, and it allowed us to get financing. And it allowed us to not have to worry about little variables with insurance and things of that nature. We dabbled in a number of different ways when it came to privacy trusts and land trusts and LLCs. And, for us at that moment, it just wasn't the right thing for us to do at that time. But it's a very personal decision for everybody. So I'm going way out of my way not to advocate for what I did. It might not be right for you, and vice versa. There's a lot of clients that use LLCs to be able to purchase their homes. And then there's a lot of clients that, choose to keep it in their personal names. I would say as a general rule, as a generalization, the lower number of properties would be where we tend to see people keeping them in personal names until they get
Mm-hmm.
to a certain amount, which is right
Yeah.
for them. And then they might move it over to an LLC.
Yeah. Yeah, I think it's interesting when you bring it up, right? Because I think most people there's so many folks that getting started to buy their first one. They're like, "Well, do I need to set up an LLC, do all these different things?" And like you almost kind of like yeah, what's the word? It's like failure to launch because you're just debating on all these different kinds of things. At the end of the day, I think your story is pretty like illustrative of even if you are, when you're buying your first couple, or even if you're like acquiring a lot quickly, there's many ways to do it. And you can kind of like, if your story is any example, you can always, go into like acquisition mode, acquire, and then figure out the legal structure later, be responsible and be covered with insurance and these different kinds of things as you're doing it. But there's like multiple ways to do it, and there's no kind of like, no one's going to give you like the silver bullet approach. It's all based on your propensity for risk and the different things that you're trying to protect and accomplish, right?
Yeah, I think we've got to take action. We've got to take action. We can't let little things like, oh, what's the name of my LLC going to be, or do I need this or that or the other thing, stop you from the momentum of taking action. So I think that's a good point. But the other thing is that even though I can't sit here and advise you on what is right for you to do, the team that you have to support you is all one phone call away. So for clients of JWB, even though we're not asset protection experts, we work hand in hand with the team that is. And the same thing on the financing side or on the insurance side. So even though we can't put the entire plan together for you, we're one phone call away. We get on the phone together and talk with the client. Say, hey, here's what the client thinks. Here's what the insurance team thinks. And so it is not like you're going at it alone, which is very different than when I started. I was going at it alone, having to figure it out. So you're in a much better place today.
Yeah, Ringmaster Drew Barnhill in the chat is saying, as someone who had a business with an LLC and gone through a lawsuit, it's so hard to dot every I and cross every T. Never have your LLC as your sole means of protection. My insurance is what saved me in this situation. Don't script on insurance. It is truly your best defense and protection as well.
There you go.
And then we have another question from an anonymous attendee here saying, is there any benefit to using a land trust? Can a land trust be used inside an LLC or Series LLC?
Probably a good question for an asset protection expert other than myself. I've dabbled in using land trusts, and I know there are some pros. There are some cons too. Ultimately, I really think you probably want to talk to an expert to get a better understanding than I can provide for you here.
Okay. So that is the update on this new Series LLC thing happening in Florida. GC, let's move on to our next topic. As we rolled into this year, it felt like we knew kind of like the mid short to middle term direction of the Fed. All signs were pointing towards rates dropping. A lot has happened since we've entered into a war. Inflation has not gone down. There is going to be a transition of Fed chair. And it seems like the Fed may be changing their tune based on all this type of stuff happening. GC, how would you summarize kind of like what's going on at the Fed these days?
They're in the news a lot, and I think everybody, including the Fed, is hoping and wishing and praying for the Fed funds rate to drop so that the borrowing costs for the rest of the economy would go down, and we just um, just been disappointed. It just hasn't happened. So,
Yeah.
I think the Fed's in a tough spot, and I think, there's just a lot of variables that we didn't know about towards the end of
Yeah.
last year or the beginning of this year, where we were all putting our thoughts together on where rates would be. And I don't think, it's clearly the Fed didn't know either.
Yeah.
But now there's a little bit more information, and you're starting to see the Fed's presidents, who together with the chairman decide on what the Fed funds rate is, start to pivot, start to make some different signals. And what's noteworthy here is the signals that the Fed is making today are affecting your properties today. They're affecting your interest rates on your mortgages. And so what the Fed actually does when it comes to either raising rates or lowering rates or whatever, that if you're going based on that to understand how this is affecting your rental property, it's too late. The time to understand how it's affecting your rental property is like right now, when they start to make some signals and some shifts. That's
Mm.
how it really works. So there are some things that are changing now.
Okay, so let's talk about the signals and the shifts. You put together a couple of slides to help us understand this. GC, what are we looking at here? It looks like a scatter plot of 2026, 2027, 2028, and long run.
Yeah. Well, you know what? Before we go there, let's just kind of talk real before we
Okay.
get like into the numbers and the dot
Okay.
plots and everything. All right. So, I think if we're all hoping that rates were going to come down sooner and faster,
Mhm.
we've been a little disappointed, like I mentioned. And we looked at why have rates been higher? Well, it's at the end of the day, it comes down to inflation. Inflation and the job market has been stronger than we have expected, especially over the last few months. So
Yeah.
when inflation's higher and the job market's stronger, that ultimately tends to lead to a higher Fed funds rate,
Hmm.
which is the rate that the Fed charges for, or banks charge each other for overnight borrowing. And then that in turn raises the rates of everything else, like
Hmm.
10-year treasuries and then mortgages. So if we could just solve this inflation problem,
Hmm.
everybody's thinking, oh man, well then we can have rates come down. Well, one of the biggest drivers of the inflation problem was the lack of oil that was traveling largely through the Strait of Hormuz because of the war in Iran.
Hmm.
And costs of a barrel of oil skyrocketed. They were way high. So, but if you look at the news over the last like weekish, week and a half,
Hmm.
the cost of oil has actually gone down. But what's noteworthy here is that our mortgage rates have not gone down. In fact, they've gone up a little bit recently. So when I was looking at this, I'm like, oh no, what's going on here? Why is this happening? We were all hoping when we started to see some potentially positive news with the end of the war in Iran and starting to see oil flow potentially a little bit more and the cost of oil going down, that would lead to lower mortgage rates. But it didn't happen. And so I wanted to just kind of share kind of like a cool like nugget thing to help, finance nerds like myself kind of understand this a little bit more. And that's really where we can get to the dot plots, because there have been that shift, and that has really superseded any positive news as far as dropping oil prices.
Yeah.
Um, and that's why our rates have gone up.
Yeah, and you mentioned something just kind of like in the understanding of all of this, right? The Fed's mandate is to keep unemployment low and inflation low, right? Unemployment has stayed relatively low. The AI jobs apocalypse that everybody continues to predict is not being shown in the employment numbers, right? Like employment's doing relatively well, so that's staying there. Like you said, inflation, when the cost of a barrel goes up, then it trickles down throughout the economy. It's not just you and me driving to and from work. It's the transportation of goods, and it like trickles into like all sorts of these other prices. So this idea that gas prices have stayed up has essentially done, like kept that there, which means the Fed, you know, looking at that, lowering rates would essentially put at risk this idea of inflation continuing to go up kind of thing, right? So now they're having different conversations inside the Fed, which is what this scatter plot shows, right?
Yeah, basically the Fed has just said, I just don't think inflation is going to come down as quickly as they had thought before, or they had hoped, or I had hoped, or probably you had hoped.
Yeah.
And this is a good segue into this dot plot thing. Okay, so what I'm showing you is a dot plot, and these are all the dots that represent what the Fed presidents believe the Fed funds rate will be in the future. And this is actually a really big deal because when the Fed's presidents, who are the decision-making body of what the Fed funds rate is, when they start to think that the Fed funds rate is higher in the future than it is today, what that signals to the market is that we should expect rate increases, Fed funds rate increases. And the flip side is also true. Um, when the Fed predicts, or the Fed presidents say, hey, I project that the Fed funds rate will be lower in the future, well, then the market takes notice because the market believes that there will be rate decreases in the future. And so it was really telling between the meeting in March and the meeting in June. Yeah, let's go to this meeting in March first. Because in March, you can see our Fed funds rate was 3.625% with a target range between 3.5 and 3.75. If that's your benchmark, then if you looked at the dot plot and the median projection for what the Fed funds rate was going to be based on the people who are making that decision, looking into the future, the median projection was 3.4. So we were at 3.625, and the people who are making the decisions are signaling that rates are likely to be 3.4 back in March. That's when everybody thought rates would be lower because you got the people who are making the decision saying, hey, this is what I project later in 2026. But then something shifted just a couple of weeks ago when it came to the June meeting here. And this is the reason why rates did not go down, even though oil costs went down, and rates have actually gone up a little bit. It's because they poll and survey those presidents after the meeting that they had in June 17th, and the median projection for 2026 rates had risen from 3.4 to 3.8. And 3.8 is higher than 3.625. So now the market is on notice, and every other investor out there is looking at this who makes some investment that is a variation of the Fed funds rate. And they're saying, oh, geez, I see higher rates coming in the future. And so the way that this relates to us as rental properties investors is what happens when the Fed projects higher median, has a higher rate projection, immediately bonds have a higher rate. So the 10-year treasury yield tends to go up. And when the 10-year treasury yield goes up, our long-term mortgage rates go up. And so that's what's happened here. So even as oil has gone down because of the dot plot of these Fed presidents and their projection that rates are likely going to be higher the rest of this year, that is the reason that our mortgage rates are higher today than they even were a couple of weeks ago, 3 weeks ago, when oil was a lot more expensive.
These dot plots are super interesting, right? I find interesting this idea that this line moved over this month, but if you look at 2027, 2028 longer run, stays pretty similar, right? Like it's just kind of
Exactly.
like the short-term projection of this thing feels like what we are seeing play out. And then these Fed chairs essentially say this, dot plot comes out, market reacts because everybody's trying to like predict the future and act as if, right? So I guess if I'm hearing anything, it sounds like, you're hearing it in the news, in the headlines, you're seeing it in this dot plot. We went from an environment where we thought there would be multiple rate declines this year to an environment where like feels like there's at least one rate increase that's happening in the near future here, according to like what these Fed chairs are predicting.
Maybe, maybe
Yeah.
not. I mean, if we were here in March, we would have had a different conclusion because
Yeah.
it would have been, a lower median going forward. I think this is fun for me to like learn, and I hope it's fun for you all to learn a little bit more. Um, but I don't think this really has an effect on your plan. If you're using this information to say whether this is the right time to buy or the wrong time to buy, you're missing the point. Because
Mhm.
number one, as we've seen in a 2 month span, the Fed presidents might have a different projection next time, and mortgage rates might go down.
Yeah.
Wow, just got excited there. Mortgage rates might go down for a
Yeah.
period of time,
Yeah.
but or the opposite may happen. They might go up. At the end of the day, your plan for when it comes to rental properties is built on a full market cycle. And if you looked over those dot plots, and you looked into the longer run, every one of those dot plots in the long run was like at least 1% lower than what it is today. So long term, I think everybody is pretty sure that there will be some rate relief, but even if it's not, just focus on acquiring assets. Focus on getting assets in your portfolio. The reality is that most clients refinance their properties 3 years or 5 years into them owning it anyways to be able to harvest the equity that comes out of it so they can acquire more assets and have more, what do we call them, Pablo?
Property babies.
Have more property babies. So don't get so focused on what the rate is today. I love this stuff. So I'm always focusing on, understanding it because it's good to know and I want to teach you all. But like don't let this take an otherwise excellent plan that you have and stop your momentum. It really, really doesn't matter that much when it comes to your interest rates, especially because today, even though the interest rates are higher than we all want, that's balanced out with really great incentives that come to you to be able to buy those interest rates down as you're acquiring your rental properties.
Yeah, I love the chat's lighting up with different examples of why it's always a good, like Leah saying it's always a good time to buy. Michael Santoros is talking about how he bought his first property with 10.9% interest rates. And as rates dropped, property value went up in time. And then, of course, Saran with a plan says, property babies, baby. That's what she wrote in there. GC, I would love to just kind of pick your brain on, we have for a while talked on the show about interest rates being high and staying high and what that does to the economy. It suppresses demand, right? Like when interest rates stay high, it keeps a certain percentage of the population on the sideline that, um, you know, isn't going to buy a house yet because interest rates are too high, isn't going to sell and then move houses because interest rates are too high, stuff like that. And we've long described it as like a coil that continues, like as interest rates stay high longer, continues to compress until once they start to drop, bang, the coil opens up. I make a funny noise, and essentially like people start to rush into the market that have been waiting to buy a home. Do you still think that that's true? Like, are we aren't like I guess my question is like, are we in unprecedented times of like how long we've been waiting for this coil to unwind at this point, that maybe those buyers have like moved on or something like that? Or do you still think that like coil theory is still fundamentally true?
Still fundamentally true and getting stronger. On the other side of higher for longer interest rates is more momentum towards people that are buying homes if you are investing in an area where population is growing. Because unless people have figured out another way that they want to live other than having a roof over their head, if your population is growing, that is more demand for
Yeah.
both buying homes and for renting homes. And there are a lot of people that don't subscribe to what we believe here in the Not Your Average Investor Show and do sit on the sidelines and wait for that interest rate drop to happen. That's the way that people normally make decisions. And so there's a ton of people that are sitting on the sidelines here in Jacksonville that are saying to themselves, well, I want to buy right now. I've been wanting to buy for the last 3 years, but I'm going to wait for that interest rate to be 6% or 5.5%. And when that happens, which it will happen at some point, you're going to see those buyers come off the sidelines in droves. And what's going to happen is we're going to have higher than normal home price appreciation on the other side of this. So just like Michael Santoros was talking about when he bought his properties, I think he mentioned it was at like a 10% interest rate. The easiest thing to predict is that when interest rates come down, home prices go up. It happens almost every single time. So if we're buying at an interest rate right now that is higher than we all want, and we believe because the Fed presidents have dot plotted it out in the future that we think rates are going to be lower, what you're likely to see is you're able to capture some home price appreciation simply because rates are coming down, and that's going to bring a lot of buyers off the sideline. That's going to be more demand for housing and more home price appreciation in your overall rental property portfolio.
Okay, so coil effect is still real according to GC. Couple of comments. A couple of folks said. I think Drew Barnes said it. Mark Norman said it. They are talking about doing away with this dot plot in the future. I don't know if that's pinged for that's in the conversation. Chris Gonzaga is asking: bank rates and Fed rates have nothing in common, right?
Well, it's all related. Basically what the Fed does is it sets the overnight rate for banks to borrow, but it becomes a baseline that all other financial instruments basically set what their interest rates are. So things like home equity lines of credit and savings accounts are really close to what the Fed funds rate does.
Mhm.
And then there's other financial instruments like mortgages that are more indirectly related, but still related. The Fed funds rate largely dictates things like the 10-year Treasury yield. And then the 10-year Treasury yield really has a strong influence on what our mortgage rates are. But yeah, it's all interconnected, and that's why it's important to be knowledgeable about what the Fed funds rate is and where it's going, because it will likely either have a direct or an indirect impact on every other borrowing or investment opportunity that you have out there.
All right, sounds good. Good summary on what's going on in the Fed today, GC. On to our third and final topic here. And this is the idea that Fannie and Freddie Mac will allow rent and utility payments to influence credit scores. Now, bigger pockets when they're talking about it, right? They took this spin of saying rent to own deals for tenants are more feasible for landlords, right? So basically, Fannie and Freddie are moving towards newer scoring slash underwriting models that can factor in rent and utility payment history, especially for borrowers with thin credit lines. Um, this could make rent to own more practical, but only for the right tenant, is what Bigger Pockets is saying. The biggest opportunity is not fixing bad credit, but it's helping reliable tenants with limited credit history prove they are mortgage ready through 12 plus months of documented on time rent payment. And landlords and property managers may become part of the credit building process, right? Rent payments are not automatically counted. Owners may need rent reporting services, bank slash payment documentation, or lender verification processes to help tenants use their payment history. That creates both an opportunity and an operational responsibility. GC, as you read this headline, this is a good thing?
This is a great thing.
Okay.
You want me to go farther?
Yeah. Go further.
It's a great thing. It's in my mind, it's long overdue. Where this is coming from is, you know, the reason that we love this asset so much is because single family housing is a critical need for the individual. It's a critical need for the community, and it's a critical need for the government for single family housing to work. And first time home buyers and helping people become first time home buyers is a critical part of what strengthens our families, communities, and that's why the government is a big advocate of it. But for far too long, people who are renting homes haven't had the opportunity to reflect their positive rental payment history when it comes to their credit score. It's just not how it typically has been evaluated. And individual landlords, if they wanted to report that to the credit bureaus, had to pay to do that. And so regular mom and pop landlords are not going to pay to report that positive rental history to the credit reporting agency. So what happens is the vast majority of renting Americans are making positive payments on their biggest expense every single month, but it's not showing up in their credit score. And what that does is it makes it harder for them to be able to get financed, to be able to buy that first home for them, or even if they do get financed, otherwise, they might have had a lower rate otherwise if they had been able to, have 10 years of positive rental history to be contributing to their credit score. So all of these things are good things because it's more accurate for our renters to be able to share their positive rental history with the credit bureau agencies, and it's going to lead to more first-time home buyers, which is a wonderful thing for our communities and our government.
When I read this headline about Freddie and Fannie doing this, my first reaction was, "Isn't this already happening? Weren't we all? Didn't we have a show with Andrew Barnhill? Sorry, not Andrew Barnhill. How am I
Smallwood.
forgetting? Andrew Smallwood, talking about the fact that that you guys have this resident benefits package and all the, like I've been in the property management industry now, like deep into it the last 2 years, and it feels like these kind of like credit reporting things are already things that property managers are doing, and I know that you guys are doing it.
We've been doing this for a very long time. Yes, we partner with a group called Second Nature, And we have what's called a residence benefit package. We've had this as something that our client residents get to take part of. I don't know. I'm gonna guess maybe like 4 years, 5 years now. And so, yeah, so we have been reporting all these positive trade lines, these positive rental payment histories for our renters, our residents, for many, many years now. And it's becoming a little bit more popular for professional property management companies. Certainly not for regular mom and pop landlords, still not doing it because they would have to pay extra. But for a regular property management company like JWB, we do it. We do it, number one, because it helps us to attract those renters to rent with us. If you're a renter and your goal is to be able to buy a home, it's a question that you should be asking. Hey, when I rent this home from you, does it get reported on my credit so that so that I can go ahead and buy a home? And then for us, for JWB, we are a big part of this community well beyond just the investor lens. We're a big part of this community because we live here and this is our home as well. But we serve about 9,500 renters, residents who rent with us. And it's really important for us to strengthen our communities by helping our renters become homeowners. By doing this, we are giving access to 9,500 residents here who otherwise might have a real challenge of taking part in the things that you guys love, which is owning homes, right? Like that is one of the things that we can do that has the least amount of barriers that helps people achieve financial stability in this country. And so one of the big missions that we have is helping our renters become homeowners. So yes, we've been doing it for a long time. Our renters benefit package has more than just the reporting of the positive rental history. There's a number of other things like group rate, internet, and renters insurance, and all this good stuff. So when a renter walks into JWB, they are able to have this suite of services that you just don't typically get. And ultimately, it's going to lead to a better renting experience and help us help those renters become homeowners one day.
When we first started talking about this and having the show, I know that you put together this chart about just how effective this thing is. I want to share this with everybody because it's pretty impressive when you see this. You want to talk through this, GC?
Yeah, and this is something that I love getting this reporting. We get a report once every quarter, and I was just in our leadership team meeting last Wednesday, and we were looking at this with the leaders on our team. Really fun to see just JWB residents how much their average credit score has improved just from renting with JWB through this type of residence benefits package. But you can see there in the bottom right, our average credit score improvement is 82 points for our residents here at JWB. Think about what that does for them when it comes to buying a home, buying a car, borrowing any type of money. I mean, this can be something that is that step towards something that is really life-changing. And the most life-changing thing out of all that we see is buying that first home, and it becomes possible just within 13 months of reporting here. Within 13 months, you can raise your score 80 points by being a resident.
Man, when I think about the credit score and like, I think we all think about buying homes, but it really is this thing that opens up the world to a lot of different things, right? Like it's just like it factors into job applications, it factors into all sorts of these different things that when we are thinking about the economic flywheel, right? And what you're trying to do in Jacksonville of like leading by raising median incomes in Jacksonville so that everyone prospers and all these different things. Whether or not someone is doing it for their own, for buying a home or not, which we have learned is the number one way to plug into the economic flywheel of a city, it's still good for them for all these other ancillary effects, whether it's car payment or getting out of like a pinch and not going financially bankrupt because something happens, like and you can borrow money to like help yourself, or again getting a better job, all these different kinds of things. That the idea that they are now enabling renters to build their credit at large, not just by these companies that are um that are doing this proactively, out of
Yeah,
choice. I think it's great that this thing spreads to the common renter, right?
I 100% agree. I mean, if we if property managers systematically help their renters become homeowners, I think our country would be in a much better place. If we could change the narrative between landlord or property manager and renter, it's pretty, I would say, known to be adversarial, and it doesn't need to be that way. If we could look at property managers or landlords being on the threshold to homeownership when it comes to renters, like that's our vision. And I think if everybody kind of thought about it that way, um, you know, it would be one of the best things that could we could do for our neighborhoods, our communities, because
Yeah.
homeownership is life changing. We've seen it over and over again because we've been able to take our renters and have them become homeowners and plug into that economic flywheel. So, yeah, I think I would really love for us to just rethink the role as property managers of who we are and what service we offer for folks. It's a lot more than just collecting rent. You're sitting here on the threshold of property ownership. You're the closest person, the closest that you have. You're the closest to the mix to be able to solve a problem for somebody who wants to become a homeowner.
Yeah.
And you do have that ability to counsel and help and do first-time home buyer seminars, and you do have access to financial information because you were there to help them be able to get qualified to rent. So you just got this trust that can be built up. And then ultimately, 2 years, 3 years, 4 years down the line, that person can be elevated to a place that they never thought they could be simply because of the property management relationship.
That's awesome. That's awesome. So Don Patterson, Don, welcome to the show. I think this is the first time we read your name. He's asking, does JWB have a rent to own program then?
Well, that's a really good question. We do not. We do not have a rent to own program, but we have something that we think is even better than a rent to own program. The reason why we don't have a rent to own program is because we are here to serve both the resident and the client. And on the resident side, in addition to a wonderful renting experience, we want to help our renters become homeowners, like we just talked about. But we have to find something that works for clients as well. So, Don, as a client or a potential client of JWB, if this is going to be an asset that you want to invest in, you're going to be investing for a long time. It's a full market cycle. And, typically rent to own would be a situation where you would rent the home to a resident and then help them build up their credit or get to a place where they can buy a home and then maybe a year or two later sell the home. And so that model isn't congruent with the investor model that JWB subscribes to and our clients subscribe to. And so that's really the reason why we don't offer a rent to own program. It would get in the way of the model and the strategy for us as rental property owners, which is to buy and hold for a very, very long time. But we did not want to not have the opportunity for renters to become homeowners. So we created a program called HomeStep. And JWB HomeStep, thanks, Pops, for putting it up there. JWB HomeStep is the first of its kind for any property management company that I have found, definitely locally, definitely in the state of Florida, and I haven't found anything in the country that has been this type of a program. But it comes out of this desire to help our renters become homeowners. And renters through JWB's HomeStep program enroll and earn $100 a month, similar to like what you would get from a rent to own program. Rent to own programs typically offer some sort of rent credit, but JWB through the HomeStep program offers that same credit, $100 a month that goes into a bank account really for a renter. And when they are ready to buy a home, they can access those funds towards their down payment or their closing costs, and they can use this to buy any home. It's not just a JWB home, it's any home in Northeast Florida, which opens up a huge range of potential options for them to be able to find the home that is perfect for them. As you can see here, we're really proud of it. It's revolutionary. We have been blessed to have the support of some of our key leaders. I know Mayor Deegan was there as we announced the program and said some really wonderful things. She's the mayor of Jacksonville, of course. But JWB has committed $16 million in HomeStep funds towards our residents to become homeowners. And we do that by giving them a maximum of $3,600 towards their down payment and closing costs, as long as they subscribe to the lease. And as long as they're subscribing to the lease, of course, paying rent on time and taking care of the home and all those other things. If they simply do that, it does not cost any money for a resident to enroll. They're going to have $3,600 waiting for them when it comes time for them to be able to buy a home. And we track and measure this, and our goals are to increase the number of renters who become homeowners over the years. Last year was the year that we rolled it out for the first time, and we had 18 families become homeowners here in Jacksonville, thanks to the HomeStep program. So that's our solution to the opportunity to create more homeowners, while also not hamstringing you as a rental property owner into being forced to sell your property prematurely.
Yeah, I love I just want to highlight one thing. I think when you and me were preparing for the summit and we were talking about the Homestead program and we're talking about the fact that like this isn't a new thing for you guys. Like the idea that 6 7 years ago you started a golf tournament so you could give away a home to a deserving veteran, and then you went from giving away one home to giving away multiple homes to veterans, and then you started giving away homes to JWB residents. And then, that led to what was it, like 8 or 9 homes that you have given away, GC?
Yeah.
To then
Well,
yeah.
somewhere around there. Yeah.
Yeah, somewhere on there to then operationalizing this thing that like can now scale, right? Like it's a lot harder to just give away a home at a time when what you're trying to create is home ownership. Create this program where year one you went from like in 6 7 years giving away 8 or 9 homes to in year one 18 families became homeowners through this thing. So it's like if you're thinking about this like headline around, so sorry, so before I get too distracted there, I'm really looking forward to what this looks like in the future, right? Like if year one was 18, I have no doubt that the way that JWB operationalizes this thing, that year two is going to be significantly more than that. And when we're looking back 10 years from now, the idea that hundreds of families will have become homeowners in Jacksonville because of this thing is not far-fetched at all. And then I just wanted to point out the difference. It's like we're talking about an article where Fannie and Freddie are saying you are now going to be able to like build your credit during rent payments. Not only has JWB been doing this and allowing renters to build their credit with rent payments before this, but you are also giving them $100 a month at no cost to them to build up not just their credit, but part of a down payment to become homeowners. Like it's just like this, like very, very like clean solution for this thing that I just find really, really impressive. Belinda Baldwin asks, are all residents aware of this program or just incoming newer residents? I'm sure this helps with retention of current residents for JWB.
Yes, all residents are aware, and we encourage every resident to sign up for it. As I mentioned, there's no cost to it, so it is available for new incoming residents and all of our residents. And what we did is we grandfathered all of our existing residents in to the program. So if they were subscribing to the lease, doing everything they needed to do, and they had been in the home for 3 years, when we rolled this out, that $3,600 was sitting there waiting for them as soon as they were ready to buy that home. So that's where that $16 million has come from that we committed to this program.
Amazing. And Or Napoleon saying, how long is the typical lease in the HomeStep program? 3,600 seems low if they're leasing for 3 to 5 years working on their credit.
Okay. So I think we just need to like level set this. This is a property management company going out of their way to pay $3,600 for a resident to leave the property management company to go and buy a home. And there's no other property management company that I have been able to find out there that would pay $3,600 for their resident to leave the home to go and buy a home somewhere else. And so I just think that's really important. The reason that we do that is because everybody's going to win here. The renter is going to win. You, as an owner of the rental property, is going to win because your renter is going to have higher occupancy and they're going to take better care of the home. And then JWB as a company wins when both the renter and the investor are winning. And so that's why we do that. To answer your question about the length of the lease, the same lease terms apply whether somebody is a part of the HomeStep program or not. They're signing a lease independent of the HomeStep program. The HomeStep program is just kind of like a free add-on for them. So for JWB lease terms, they're generally between 2 to 3 years because we sign long-term leases. And so, a 2 to 3 year lease would be the initial lease. And then we work with the resident to continue to renew until the point where they're ready to buy. And when they're ready to buy the home, we're going to give them this gift of $3,600, and then we're going to help them buy a home many times from somebody else other than JWB, and ultimately kind of complete that big step for them in their lives.
Do you see, you were talking about, she's talking about this idea that it helps with longevity, right? Um, oh, and she's asking, does the 3,600 come from the PM or from owner proceeds? This is just JWB's money gifted as free money to the renter. It does not come from owner proceeds at all.
That's exactly right.
Got it. Cool. You were saying something, we're talking about how like this helps with like staying, right? Like longer leases, sticking around longer. You also brought up something to me before the show about how it also decreases turn costs, right?
Yeah, yeah. So this. I've been sitting on this data for a while, but I wanted to share it with you as we kind of wrap up the show here. This great thesis of doing the HomeStep program was that everybody would win. And the way that you would win as an owner, as an investor here, is you're going to see much lower vacancy costs and much lower property turns. And that's what we're seeing across the board. We have really low vacancy right now. But the property turn cost is really fun to share with you. We look and we track the average property turn cost for a resident that went from being a renter to a homeowner through the HomeStep program. The average property turn cost $38. So what that means is when somebody is a part of the HomeStep program, they love the home, they love the experience, they love helping hand to take them to that next level, and it shows up not just in occupancy, but how well they take care of your home. So we're really, really, really excited about that. I've been sitting on that data for probably like 6 months to a year because I wanted to get enough examples, but we're seeing this over and over and over again. So a great example of how we all can win here.
Really, really awesome, GC. I think that's a good way to put a button on this conversation. Um, Summarize today's show. Essentially, new LLC series law that allows for new options, simplified asset protection strategies in the state of Florida. The Fed is now maybe not lowering interest rates, maybe raising interest rates. There's a lot going on with the Fed, a lot to keep track of as a finance nerd or as a rental property investor. But the Coil effect is still real. At some point, we do believe mortgage rates will go down in the future, and it's important to be investing in a growing market so that you know that your rates, that your property values will continue to go up because there is suppressed demand of all the folks that have moved here and haven't bought a home yet as well. And then last but not least, we love this move by Freddie and Fannie to allow renters to build their credit by paying their rent on time. JWB's been doing it now for a multiple of years, plus also enabling renters to become homeowners through the HomeStep program, which was rolled out last year, already helped 18 families become homeowners in 2025. How'd I do there, GC?
Well done, buddy.
Well done by you, man. Thanks for preparing this stuff. Well done by the community. We had 70 plus people showing up here today. I know you all love talking asset protection and Fed stuff, but we really, really appreciate you showing up here on a Tuesday, middle of your workday. Continue to be part of this community. Continue to get educated. Love the new names chiming in here in the chat. Make it a habit. Would love to see you around. Would love to give you a nickname at some point to make you an official part of this, like the inner circle of this community. And we'll keep on showing up here on Tuesdays, keep giving you good updates. Next week, we're going to have a guest investor on that's a JWB client to talk about their experience. And from now till then, any advice, GC?
Don't be average. See you, everybody.